Welcome, Honourable Minister.
Thank you,
It's a privilege to have you here, and it's also a privilege for the investor community investing into India to have a Minister in Finance who has a track record as a venture capitalist and investment professional. So obviously you bring in a depth of experience and an inside view on how things can work better. So if I were to kick in with the macroeconomic sort of questions, India is now clocking at a 7% or higher GDP growth rate, and in the context when a lot of emerging markets are struggling with issues, it's probably the fastest growing major economy. However, there is a view that in the Indian context, really you need to clock 8-9% GDP consistently over years, really for the objectives of employment generation, poverty alleviation, etc. to really kick in. So it'll be great to have your perspectives on what do you think are the enabling factors which will get us there, and what is the government doing towards that objective, be it on capital, labor, productivity, that will drive us in that direction.
Well, that's the $10 trillion question, isn't it? Because we have a $2 trillion economy, and if we can grow for 8 or 9% a year for decades, we can of course become a $10 trillion economy. And the question really is how, right? And that's what everybody wants to know. That's what you're asking. In a line or in a sentence, I would say that what we want to do is to build India's productive capacity, India's hard assets and India's soft assets, because we really need to build up on the supply side. And we need to make sure that we have sufficient investments going into productive capacity so that we can sustain growth over a long period of time. India has had flashes of high growth. We've grown 8, 9, 10% for a period of 3, 4, 5 years, but we haven't been able to sustain that over decades. China, on the other hand, has been able to grow 9% a year for 30 years.
That's correct.
And today the GDP per capita is 5,500, whereas ours is about 1,700 or so. And that is because they've been able to sustain growth at that very accelerated rate for a very long period of time. And so if we have to do that, if we have to eliminate poverty in India, and we have to provide jobs for all of our young people, which are our two most important priorities, we have to be able to build up our productive capacity on the supply side in an investment driven way so that we can then sustain growth over a very long period of time. That in a nutshell is our economic strategy. And so when we think of productive capacity, we're thinking of the hard assets as well as the soft assets. The hard assets, of course, being the roads, the bridges, the highways, the ports, the railway lines, the airports, everything that's needed to power an economy forward. But the soft assets are equally important. And our soft assets are obviously, the skills of our people, their employability, our innovation ecosystem, and very importantly, our institutional capacity as well. And that, of course, means our regulatory institutions, our judicial system, and, of course, our parliament as well. So we have to build up our hard assets and our soft assets. We do that, we build up India's productive capacity, and we power growth forward for the next few decades.
Since you brought up parliament, it brings me to my natural next question.
That was a setup.
So how much of this is within your control? I'm sure there are certain elements of reform that the government can do given the executive authority it has. And how much of it is dependent on support in Parliament, in the upper house of Parliament, and also what parts of it really devolve on the state, as we're increasingly hearing on issues like land and labor, some of it needs to be done at the state. So it'll be good, for global investors to have a perspective, the growth rate could be even higher if there is political consensus and support, but even without it, what is achievable?
Obviously, Parliament is hugely important. There is a lot that we can do through executive action, and we're doing that. There's a lot that we can do through money bills, which only need to be passed in the Lok Sabha, the lower house. And typically it's the budget which is considered a money bill, or there are other money bills as well that we've had and that we've passed. So between executive action and money bills, which is essentially the area where we can go ahead and get things done, we can obviously do a lot of what is required to really drive the economic agenda forward. Nonetheless, when we want to get a majority in the Rajya Sabha
Right.
to be able to pass a non-money bill,
Right.
we have to work very hard.
Right.
Now, we are able to do that. For instance, I was the person who piloted the FDI in insurance bill.
Correct.
So we passed it easily in the Lok Sabha. In the Rajya Sabha, we had to spend a lot of work, a lot of time as well to knit together a winning majority there, which we were able to do. And so we were able to pass FDI and insurance there. But when it comes to a constitutional amendment,
Yes.
there we need a 2/3 majority in the lower house, the Lok Sabha. We need a 2/3 majority in the upper house, which is the Rajya Sabha. And then we need 50% of each of the states to be able to pass it as well.
Right.
And that's the reason why GST stuck.
Right.
GST stuck is because it is such a sweeping change to the taxing powers of the center and the states that it requires a constitutional amendment.
Administrative reform, which also has been a focus for your government, just streamlining administration, ease of business, reducing clearances, making it easier for startups to kick off business, more of e-governance, which is a facilitator for this. Could you talk a bit more on what's happening on that front, and when can businesses and investors expect to see some benefits on the ground?
It's already happening.
Okay.
Yeah, businesses are already seeing, lots of changes as far as filings are concerned, as far as taxation is concerned, as far as government approvals are concerned, environmental clearances are concerned. So I think we've really made a lot of progress there. Of course, we'll see where the World Bank rankings come out.
Okay.
But the Prime Minister said we want to be in the top 50 in the next 3 years. So I'm sure we will get there in the next 2 or 3 years. And as far as startups are concerned, we are thinking through what we can do to ensure that India is the best place to do business for startups. We have some very radical ideas that we're working on there. The appetite to do it is absolutely there. The willingness to do it is absolutely there. But we have to make sure that it is implementable, that we can carve out for startups, for instance, a zone where the whole regulation and compliance aspect is very lightweight.
Sure.
But that is a complicated matter because we have to be able to define a startup and be able to put it cleanly in a box.
Right.
So obviously those are things that we have to work through, but the intent is absolutely there. So as far as ease of doing business is concerned, the Honourable Prime Minister has said that we want to roll out the red carpet, not the red tape.
Okay.
And we are absolutely focused on that. If it's a one-off situation, we're already telling businesses, come to us, we'll find a solution for that, and we are working it through. But of course, we want to tackle it at a systemic level for all the different things that you have to do if you're going to start and run a big business in India.
Just coming to the specifics, is digitization and e-governance the biggest tool for handling it and for transparency?
It's too broad a subject to be able to say that there's one thing. There is no silver bullet.
Right.
I mean, whether it's labor, we have a portal now to do labor filings. Whether it's environmental clearance, that has been taken online for just now.
Sure.
If it is FIPB and filing for FDI approvals, that has been streamlined, and you can do it much more quickly now than you could do earlier. So in every area, we are hacking away at all of the rules and regulations. For instance, we've just passed a law that enables us to try and clean up the statute book and take antiquated laws off the statute book so that they don't exist any longer. So across the board, it's like a spring cleaning. We're going through and we're removing all kinds of stuff that we think is getting in the way of being able to do business.
That largely is, executive power, but of course some of it lies with the states.
Some of it lies with the states. I mean, even for the states, as far as ease of doing business is concerned, we have come up with a 300-point benchmarking process, which each state is looking at and trying to figure out what is it that they can streamline. In addition to that, we have already ranked all the states in terms of ease of doing business. And for startups in particular, we want to carve out a zone where it's going to be very, very lightweight in terms of compliance and regulation.
Okay, great. Coming to the government spending and the quality of government spending, obviously infrastructure is an area where the government is having to jumpstart some of the spend. In any case, the shift from unplanned revenue expenditure to capex, productive capex is desirable. Would you like to just talk? Of course, that gets covered in the budget in detail, but directionally, long term, what are you trying to get to? Would you like to talk about that briefly?
Yeah, the quality of our expenditure has improved dramatically in three very important ways.
Right.
Number one, what we have done is that we have devolved a lot of the tax pool to the states themselves.
Right.
So if you want to run a welfare program or you want to invest in a certain type of infrastructure, the states can customize it to their particular needs. And we moved away from this one size fits all.
Okay.
So we've done that with respect to providing those resources to the states, number one. Number two, we've cut back heavily on subsidies. Subsidies were up to 2.6% of GDP, fuel subsidies, food subsidies, and so on. That has come down now to about 1.5% of GDP. So we've brought down the expenditure on subsidies, which was, obviously not as productive as expenditure in other areas. And number three, we've stepped up the capex in our budgets dramatically. So the railways, for instance, had not gotten any capex in the last 10 years.
Right.
They've got a significant amount of capex, $150 billion over the next 5 years. We've really stepped up capex in roads and in bridges and ports, in irrigation as well. So capex has gone up dramatically, which has high economic multiplier effects, and that obviously improves the quality of expenditure. So less subsidies, more to the states, and more capex. So qualitatively, if you look at the nature of fiscal expenditures, we think it's been dramatically improved.
A net outcome of all these factors, and of course, tailwinds of crude prices and commodity prices, the inflation has come off considerably. The deficits have narrowed, and as a consequence, the external perception was that the Indian rupee was a very volatile currency. In the last couple of years, we were tracking it, and we saw it was in fact one of the least volatile and most stable currencies. At the same time, the question is, how well equipped are we to any external headwinds or shocks again?
Number one, you have to look at the basic macroeconomic foundations.
Right.
Number two, you have to look at the amount of reserves we have.
Right.
And then number three, you have to look at the policy making as well. On all three dimensions, we are in very fine shape.
Right.
And we think, therefore, that the currency is going to be in a very stable zone and fairly robust going forward. First, with respect to the macroeconomic foundations, whether it's inflation, current account deficit, fiscal deficit, investment ratio, all of these macro parameters now are looking very good for India. They're flashing green, and the World Bank, the IMF, the rating agencies all recognize that India is in a macroeconomic sweet spot right now, based on the policy actions we've taken and because of where the commodity cycle is. So the macroeconomic fundamentals are very robust, number one. Number two, our foreign exchange reserves are at $350 billion and growing steadily, and so we have plenty of firepower. Added to that, of course, is the swap line that we have, the $50 billion swap line that we have with the JCB. And then finally, we always have the ability to tap into the diaspora wealth, which is what we did last time when we had, in September 2013, a little bit of a sort of a currency zone where things were a little volatile. So we have tremendous foreign exchange reserves because of that. And then number three, if you look at the policy making, I think there's very, very clear alignment between what the government wants to do, what RBI is thinking about in terms of monetary policy and in terms of currency management. And so that policy framework also is very, very strong and very durable, we feel.
Okay.
The combination of these three factors, to my mind, puts the currency in a very good zone, and these have been in place over the last year or so, which is why the rupee, in fact, has been one of the more stable and better performing currencies globally.
Just moving back to infrastructure, since obviously that is India's weak spot and acknowledged to be so. The government has spoken about a lot of stalled infrastructure projects and what it's doing to kickstart this, apart from government spend, because private sector has its own issues with leverage in today's context. So, specifically on infrastructure, what do you see as having been achieved already, and what is the key milestones moving forward?
You asked the $10 trillion question, now you're asking the $1 trillion question, right? No, obviously we recognize that we have to invest $1 trillion in infrastructure over the next 5 or 10 years. and to be able to make that happen, to be able to ensure that our citizens get the infrastructure that they deserve, that investors get the returns that they deserve, we have to do just a whole raft of things. I mean, there's 20, 30 things we can talk about. Let me just pick on 3 important things. Number one, we are trying to put in place the regulatory framework or the regime so that people can invest in confidence. So whether it's roads or in railways or in for example in the power sector, we are trying to put in place the regulatory framework so that there is stability, there is predictability, and people can invest in confidence. That's a very important area that we are working on. Number 2, what we are also focused on is cleaning up the problems of the past. The problems of the past, whether it's in the distribution companies in the power sector, whether it's a host of stalled projects in roads and in ports, whether it is problems in the steel industry. There's a whole host of legacy assets that are over-levered, that are not viable any longer in terms of their operating cash flows, etc. So there's a whole workout process happening across the economy with the banks, with the National Infrastructure Investment Fund, and so on, so that we can actually get these stalled assets under control. So that's number 2. Number 3, what we are working on also is to fundamentally change the financing of infrastructure. A large reason why we got into trouble with the stalled projects and so on is because we didn't have long-term equity capital. We had the banks with a huge asset liability mismatch, 5-year money, 3-year money financing 25, 30-year assets in a situation which really made it difficult for them to be able to provide adequate support and work through the ups and downs that you have in the infrastructure cycle as well. So we have to change the very nature of infrastructure financing. For that, we've obviously got the National Infrastructure Investment Fund that's coming up, that hopefully will add $10 billion of equity capital a year. But this particular fund that we are setting up, we think is going to be really unique. For one thing, we made it very clear that it's going to be arm's length and firewalled from the government. It's going to pay market salaries. It's going to have external investors who are well known in the long-term investing sovereign wealth category, who will sit on the governing council, the investment committee, and so on. And we made it absolutely clear. That government is not going to have more than 49% under any circumstances in any fund and in the ownership structure of the National Infrastructure Investment Fund, because we don't just want to firewall it for our government, we want to firewall it for all governments in the future as well. So we're going to create a de facto sovereign wealth fund type entity that will get $3, $4, $5 billion from the government every year as long-term equity capital, and then in addition to that, get equity capital from other sources as well, which gives you dry powder of $10 billion a year. Of equity capital. You add debt to that, you could take on some $20, $25 billion worth of infrastructure projects a year. So we think that that's going to be a very, very big boost to financing India's infrastructure sector. Secondly, we are also deepening our corporate bond markets so that you can finance infrastructure that way. We once again opened up infrastructure bonds so that many of our infrastructure financing agencies, the power financing agency, the railway financing agency, can tap into bond markets. Number 3, we are trying to get our banks to get really specialized and differentiated in terms of financing infrastructure projects and so on. So we are really trying to change the manner in which infrastructure financing has been done in India, because unless you really have that expertise and those deep pools of long-term capital, it's not going to be able to enable us to drive this $1 trillion worth of investment in infrastructure that we so sorely need.
Absolutely. No, so on the NIF itself, you said the LP contribution in private equity parlance should be limited to sub 50%.
No, the other way around. Government's contribution is going to be 49%. Suppose we started a $1 billion renewables fund, right? So the $1 billion renewables fund would have, let's say, a couple of $100 million from NIF as the sponsor of the fund. You might have another few $100 million coming in from some other government enterprises like the NTPC, National Thermal Power Corporation, NHPC, etc. So some other government entities might contribute another few $100 million. So we'd have $300 or $400 million. We would then bid that out to GPs.
Oh, you'll bid it out to GPs.
So this would be externally managed. So we'd say to the GP, okay, what is your ability to A, manage it for return, and B, raise additional funds? So a GP would come forward and say, yes, we have a phenomenal track record in renewables. Net cash on cash has been 12% over these 3 funds that we've done, and because of our own LP relations and our ability to do fundraising, we'll be able to raise another $600 million. And so you have $1 billion renewables fund as a result of that. So that would be an external outsourced fund management type vehicle where we would be the anchor or the sponsor investor. We would also consider funds where we would be actually managing it ourselves as the GP, but we would then be able to bring in investors as well. So we consider that as well.
So moving specifically to private equity, and again, it's an avatar you've been in, you've seen the opportunities as well as the challenges. One of the long-standing asks for private equity, global private equity investors coming into India has been parity with public market investors. To pick a specific example, I think the government has been quite visionary in some of the safe harbor provisions that have been spelled out, but it seems to be targeted more.
Well, there are 2 parts to that. I mean, if you're saying that unlisted securities should not attract long-term capital gains, let me explain. First of all, if you're in the public markets in India, you're paying securities transaction tax, which you don't pay for unlisted securities. So that's one factor. Secondly, if you're coming in through a Mauritius or a Singapore entity, again, you're not paying any capital gains. So by and large, for external investors in India, we obviously don't have any capital gains, and so you're on par with listed securities. Now, if you're a domestic alternative investment fund, an AIF, yes, you do have that challenge. You're not paying the STT, the securities transaction tax, but you are, of course, paying long-term capital gains at a rate of 20%. Now, if you set up a fund in India, whatever it is, you end up paying MAT, which is at 18.5% as well. But we're looking into that. We're trying to see what are the ways in which we can further support domestic private equity.
Right. But in principle, you agree that private equity is longer term stickier, so it should try and obviously not everything can be mirrored exactly, but the principle should be people should be as strongly incentivized as public markets in terms of tax regime, etc. Right?
No, I think that generally is the right way to look at it.
And specifically on the safe harbor provisions which your government spelled out, which is very progressive and in line with the vision of making and managing in India that the government has.
That is all under discussion right now. We have said all along that we want to make India a hub for investment management. And so we want Indian managers to be based right here in Bombay or Bangalore, wherever, and to be able to manage funds all around the world without any tax liability. When we did it in the budget, we made it, I think, absolutely on par with the best regulation in the world for mutual funds, public funds. Thereafter, we realized that obviously it didn't cover venture capital and private equity very well. And as you probably know, we've been working with IVCA and with a variety of other parties to ensure that we put in place those tax regulations such that you don't attract that incidence. And now the question really is exactly how we draft it.
Because one of the challenges for the industry is for mutual funds, there is the FPI tag at least. For the dollar private equity industry, there's no tag today. The only tag was FVCI, which is somewhat restricted. So the challenge we run into at any point is there is a problem in applying any benefits specifically.
No, I understand. So we're working on that. Those series of consultations are on in a very detailed manner. And we are very hopeful that we'll be able to address it because we do want India with its fantastic talent and all of its great investment opportunities as well to really be a global hub for investment management.
So just to wrap up, momentarily, I'll request you to put on your investor hat again. And given what you see, and now you have an inside perspective from the government, what do you see as the opportunities and challenges for private equity investment into India, and how do you see the sector sort of evolving?
India is one of the most exciting opportunities to generate returns anywhere in the world, I would say. Look, I told you right at the outset, our goal is to be able to sustain growth at 7, 8, 9% over a long period of time. we are a $2 trillion economy. If we grow at 7% for the next 10 years, we'll double the size of the economy. We'll go to $4 trillion. If the rupee strengthens, we could even be a $5 trillion economy. So we're going to add $3 trillion to GDP over the next 10, 15 years. Now, generally, market cap to GDP in India, private as well as public securities, has been 1:1.
Okay.
So if GDP is going to go from 2 trillion to, let's say, $4 trillion, and we're going to add $2 trillion, market capitalization is also going to increase by $2 trillion. So here you have an opportunity to create $2 trillion of wealth. I'm not sure there are many other $1 trillion wealth creating opportunities lying around for investors. So what I say to all investors is, India is open for business. You can generate fabulous returns. Not only can you generate fabulous returns, the cash leaves the country, it goes into your bank account, and you look good to your LPs. So I think it's a very exciting time to be investing in India. I'm, in fact, in some ways kind of disappointed and sad. I'm on this side, not on your side.
I think you're a very, very, very appropriate position for the country. But any challenges, any words of caution for investors?
No, the word of caution simply is that you can't be short-term oriented. But again, as I said, if you look at the long-term opportunity in India, trillions of dollars of wealth creation is going to happen. There are hundreds of fabulous companies here. Many of them today in certain industries going at ridiculously low valuations. So in that sense, you got to take a long-term view. You got to figure out who the good teams are that you want to back, and you got to be on the ground here in India. You do that, I made a lot of money in India, so obviously I'm going to recommend it to everyone else.
Thank you, Minister, and we all hope forward to reaping the dividends of some of the measures that you said are put into place. Thank you so much. It was a pleasure talking to you.
You're very welcome.